Hello, everyone, and welcome back to the Financial Freedom course. In today's topic, we're going to be talking about risk management and diversification. Are you putting all of your money on the line? This is actually something a lot of people do when they want to get rich quick. When there's high risk, there's also high reward. So to some people, this can be like, I'm going to put all my money into this stock, into this trade, into this cryptocurrency, and just hope that it's going to work out. Well, what happens if that goes to zero? What happens if you put your entire life savings, you have $100,000 or more, and you put it into something that is very risky because you read online that it's going to be booming and it's going to times 5. So you thought, oh yes, $500,000, I'm going to be so rich. Well, you didn't think about the downside, did you? You didn't think what could happen if it goes the complete opposite direction, that perhaps the person and the information you were reading online it was false. It was misleading. It was to get you to buy so that you would lose more money. Because what if it does go to zero and you lose all of it? You have no backup plan. You have nothing planned because you have put all of your money on the line, and you risked it all and you lost it all. Where there is higher risk, there should be less capital invested. So if you're investing in some sort of company that is very risky, or a cryptocurrency that is very risky, you don't want to put all your money in there. You don't even want to put the same amount of money in there as you would something that is a well-established and well-trusted company. You want to put only 1% into things that are higher risk. And you want to put a higher percentage into less risky places. High risk versus low risk investments. High risk investments can include cryptocurrencies. Cryptocurrencies are relatively new in the grand scheme of things. It's been around for many, many years, but it is still relatively new compared to the monetary system. And not only that, but you have well-established crypto projects, and then you have ones that are very risky that will literally go up 100,000% in a very short period of time and then completely sell off to basically zero. So these are very, very risky things. You can make a lot of money for it, but you can also lose a lot of money, which means don't put that much money in it. Other high-risk investments include new startup company stocks, brand new company that you're very interested in, that just started publicly trading. You don't want to be putting all of your money into that right away, no matter how much you believe in that company, because it could be very risky. Their business plan and the way that they're operating business may seem solid, but there could be screw-ups along the way. And perhaps things don't turn out the way that they did, and they report bad earnings, and it just continues to go down, 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 and your investment then is worth nothing. Or you don't want to put money into a new venture that has no track record. If there's something that is brand new, and you don't know about it, and there's no track record from the past, this is considered a high-risk investment. Lower risk investments include long-standing company stock. So things that are well established for many, many years. If a company was formed in 1980, that is a well-established company. Perhaps they have been publicly trading since that long as well. That is a well-established company. So you can look back at their stock chart and say, over the past 50 years, they have always consistently been going up, 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 up. That is a very, very important thing to look at. As well as established businesses. Businesses that have been around for a while, they know what they're doing, and they are established. Those are lower risk investments. You also want to diversify where you have your money and your different investments. You want to have your money in different stocks, funds, and cryptocurrencies. If you think that, because you love Apple, you're going to put all your money into Apple, or however much money that you think is, suitable for Apple. Apple is a solid company to be putting money in, but you don't want to just have that be your only form of investing. Furthermore, you don't want to just put all your money into one fund. You want to be diversified a little bit, even funds are certainly a bit different, because funds are more diversified in general, because they are often a collection of various stocks. So they tend to be much safer bets. So you can often have maybe 2 or 3 funds and be pretty safe there. Or cryptocurrency is another one. Maybe you have a lot of your money, like Bitcoin's the only thing that you do. But if you're invested in the crypto space, maybe you want to branch out and have a few different ones here and there because you never know what could really happen. You want to be invested in different sectors as well. If you worked for a pharmaceutical company and you love pharmaceutical stocks and everything, and you put all your money into that, that can be a very, very good investment. However, you're not invested in the tech sector. You're not invested in real estate. You're not invested in these other sectors that could benefit you greatly if, for whatever reason, the pharmaceutical industry, the healthcare industry is struggling for a few years and the tech industry is booming. Then you won't be able to capitalize on that massive growth of the tech industry because you have no money invested in it. You also want to have different accounts. You don't want to have all the same account for everything. You want to have different accounts that you're spacing about your money. Perhaps you have a dedicated savings account where you put money aside that, earns high interest. Then you have another checking account, perhaps even at a completely different bank that you use for purchases. And then perhaps you have another account that you have for your long-term portfolio of invested stocks. Perhaps you have another retirement account through your employer. Perhaps you have various crypto accounts through different places, or ideally, you have your own crypto wallet and you have different things within there. It's very important to diversify these things because if there's a problem with one of them, then you still have a backup elsewhere. In our next part, we're going to talk about multiple sources of income.